Hi, I'm Ken from Avvora Finance.
Hi, I'm Debra from the Property Frontline, and you're with Property Mythbusters. We're here to bust some myths around the contradictions and misleading information in the property space. And for the next 10 minutes, we'll be providing you with a current market update. And we've also got a special guest today to discuss aspects of the new Homebuilder grant. So, Ken, would you like to get started with a market overview?
Yeah, sure. I guess, one of the key focuses at the moment is that lenders are still struggling with service levels, although they have seen improvement over not all, the majors seem to be struggling with a lot of that. There's also, it's interesting, I came across a couple of articles about, in uncertain times, majority of borrowers or applicants are looking at more of the major brands. That's been a little bit interesting. You see here, like on this graph, there's two graphs here. I'll talk about the one just down the bottom here. On here, so that one there, the refinances are basically, creating a lot of the volume of home loan applications that we're seeing. 69.44%, well ahead of purchases, which is 22.27, and then there's a few other reasons there, which is consistent in terms of what the lenders are doing. There's a lot of promotions, cashback offers, and things like that. So if you are looking to refinance, everyone else is doing the same thing. It probably makes a lot of sense given the restrictions and everything, uncertainty about work, finding ways to potentially save money, and interest costs comes to mind. So that's something that we're seeing across the board, which is seeing a lot of influx of the volume of work that we're coming across. But that top graph there is relatively interesting. So so here we've got the percentage change and the week on week, and we've seen an increase. So this information is provided by CoreLogic.
Yeah.
So they do a lot of research and statistics on within the property space, and so this graph is basically showing that there has been a 16.93% increase. Somewhere from here to about to where we are here, there's been a 16.93% increase.
That's huge in a week.
Yeah, so you can see that there's still a lot of activity happening in the marketplace, primarily within the refinancing space. I'm not sure whether the refinancing is combined with cash out components, because it could make a lot of sense that one could be like saving on interest costs. Another one could be, refinancing and cash out. I've got a client who's doing that. So they're wanting to upgrade, so preparing for a purchase or an upgrade, new investment. So we're not sure, what the reasons are. But in terms of the S weekly, so this S weekly is just showing what the current week volume is, mortgage activity is, compared to last year, same time last week. So that's just that little gap between the blue line, which is 2020, and the grey line, which is 2019. So there's a slight increase. But one thing that we were discussing prior among those was that the year-to-date year-on-year figure is actually it's 10%, 10.79%. And what that's showing is basically from January, from here all the way through to where we're at now. Sorry, I can't draw straight lines.
There you
are. But you can see that there's a lot of areas where the blue line, the blue line is above the grey line, except for
last year.
Yeah, except for this area here. So what that's indicating basically, or just showing, is that since January, right up until now, there's actually been 10% more mortgage activity compared to last year. from January up until June.
Yeah.
So
okay.
there's a lot of activity happening in the mortgage space, which could be a precursor to what's happening, what can potentially happen in the property space in terms of demand and borrowers and purchasers going out there. But yeah, usually from what I know, the credit side needs to kind of kick off first before anything kind of flows onto the property market. Doesn't mean it will, but kind of like a canary in the mine, so to speak. So yeah, that's basically the update from myself in terms of what's happening in the mortgage space.
And didn't you say there's a few of the majors have changed their combined?
Some of the lenders who were having high LVR, so offering
so LVR is loan to value ratio.
Yep, loan to value ratio. So how much the loan is compared to the size of the
value of the property.
So if you're borrowing 100% of a $500,000 property with a $500,000 loan would mean you've got an LVR of 100%. If it's 400,000 loan and a $500,000 property, then it'll be an 80% LVR. So they were going up to like 97, 98% LVR, which is really high. Usually how they do that is the base. They'll include lender's mortgage insurance in there if it brings it up to 97, 98. So at the moment, we've seen some of them scale back and just put a hard stop at 97%, 95%, inclusive of LMI. So you can't, effectively borrow more. And it's just a more of a way to manage their risk and make sure that people aren't over gearing, just given the way that the economy is going. I guess there's a lot of question marks how the property market's going to go, etc., and stuff like that. So that's everything. Okay,
sounds good. Alrighty, so I'll just switch over to my information. So from a market perspective, the last couple of weeks since we've provided the last update, we're seeing much more activity fueled once again by that homeowner grant. And this is reflected in some of the stats that we've seen from realestate.com.au. And this is a graph that we've been talking about for the last couple of episodes of Mythbusters, where you can see the huge big drop off. And then this is the last graph that was published on Tuesday. So things are still, search activity is still off the charts. So, if you think back to how hot the market was prior to COVID-19 coming in, so things were pretty hot around here, so lots of buying activity, and then it dropped off, and now it's just sprung back to activity that we haven't seen in probably since this graph's been tracked. I think they've only been keeping track for about the last 2 years. So that is showing more activity for searches. The interesting one that I think, this is commercial, sorry, that was for residential. So we're seeing kind of something similar, though not as much of a percentage bounce, because commercial searches dropped much more of a percentage into the negative. But if there's so much business negativity out there, why are we seeing so much activity for new leases? Maybe it's because people are looking to find different, like renegotiate their leases and move. But usually if you're a business, you want to stay where you are. So I think it shows an indication of confidence. Now, this final graph that I'll talk about is the weekly count of properties moved from for sale to sold. And if you look at the grey line, which is last year, so 2019, and the red line, which is this year, once again, we see what we experienced last year that we didn't really talk too much about. So there was this huge big dip in activity just prior to the federal election. And basically, we're now kind of coming back to sale versus sold, so market activity, purchases, sort of pretty much on par to where we were last year. So what does this say? Basically, we are still, we're coming off very low sale numbers, so not as many properties available for sale, but the more stock has come onto the market, and so that's where we're sort of seeing that activity parity. Generally out in the market, we're seeing many more people at opens. Auction clearance rates are still indicating that we're in a buyer's market, so it's below 50% clearance rate pretty much Australia-wide. And so where to from here? You know, it's still the same kind of situation in that good quality property is holding its price, and in some instances people are paying a little bit more for it, but overall there's a market drag because we have got a lot of bad quality stock. So it's a very sad story for a lot of apartments. But now it's time to hear from our special guest. So I'd just like to introduce Scott Hochgesang. I always got to practice saying that surname. So Scott has an extensive property history, and he's going to talk to us a little bit about the Homebuilder grants, some of the pros and cons, and some of the myths. So Scott, would you like to kick it off?
Thank you very much, Deborah. I'm happy to have this opportunity to join the Mythbusters crew. I've certainly followed you guys as you've built the show up through the months, and a lot of interesting content going out to buyers and investors. I work primarily in the new property space, and my expertise would cover New South Wales, Queensland, Victoria, typically our capital cities, but we're also active in satellite cities like the Sunshine Coast and Newcastle, and over in Canberra. So I guess I came in today to throw out kind of a couple of myths that in the theme of the show we might try to bust a bit. And the first myth I think that's really out there is that all these government cash grants are for first home buyers only. You know, and historically that has been the case. If you get a New South Wales $10,000 grant, you need to be a first home buyer. But the new $25,000 federal home builder grant has relaxed that requirement. So they're actually allowing people who have had homes in the past or own investment properties to receive this grant. And it does open that up to a much larger universe of people than has historically been able to take advantage of the grant. So not everyone's kind of aware of that. And the details are still coming together on this home buyer grant. We're working on fact sheets from the government. We've got specifics and requirements, but honestly, it is still being locked down with the states. And these grants are going to be delivered from the federal government through the state infrastructure down to buyers. So it's a bit of a working progress where it's good to quickly get up to speed on where they're at to see how you might take advantage of them. But just be flexible and prepared because we may still see some tweaks along the way. So that's probably myth number one is, hey, there's money out there even if you own property today. The second myth I hear in Sydney a lot is, well, you know, property's just too expensive here. I can't find property under the thresholds to be able to build a new home. And that home builder threshold is $750,000 for a house and land package. So that means you need to source a block of land, find a builder to build you a home for under that amount, to qualify for the grant. It's the same for the New South Wales $10,000 grant. You can find land out there. It is in our outer suburbs, ranging from down in the southwest, the Leppingtons and the Australs, of which I know Deborah knows those areas quite well because of everything going on with the new airport at Badgerys Creek. You can find stuff out west. We're thinking out west of Blacktown, heading up into the northwest, and as you move up onto that northwest train line, all the way out to Box Hill, coming back in toward the Schofields and Riverstons. So those are areas where you might be looking, where we're seeing land being available. And the government believes that this is going to generate an extra 20,000 new property sales and new builds of properties using these grants. I'm actually starting to get the feeling that that number may be higher. And it's supply-based, yes, but the second thing we're now seeing is that for properties that aren't eligible for these grants, let's say it is an $800,000 property, or it is a house that's under construction by a builder, those would not be eligible for the grants, but the builders and developers are actually coming to the table and offering buyers that $25,000 directly. So in a sense, they're having to compete with the government incentives.
So yeah, you were talking about places like Leppington, Austral, with the airport here, and then on and up into, well, you know, Box Hill, out this way. Yeah.
Riverston, Marsden Park, and heading northwest from there.
Yeah.
And what I think is important is that people look closer to the train lines. I mean, if we're going to be that far out of the city, the last thing you want to do is have a car or bus only commute as your way into work.
Yeah. Yeah, okay. And so what was the last point that you were making? Oh, that, because there's a deadline that the builders and developers, is that what you were saying?
Yeah, the builders and developers are actually offering these grants directly. And Deborah, I don't know if you can see that image I sent you of a developer promotion.
Like this one?
Yeah, yes, that one. So these are some blocks of land very close to Leppington Station. They're within 3 kilometers of Leppington Station.
Lucky John's not here.
Project called Loom. And that land's not going to register till early next year. So it's not eligible for the grants. It's too late. But the builder basically said, hey, we're going to match the grants anyway, and has put out the word. And we've watched the project sell about half of the homes in there in a 2-week period. Wow.
So, what size blocks would they be on?
The smallest would probably be around 280 to 300, and you'd have a 3-bedroom house on that. The typical large blocks are low 400s. And there we're looking at putting together a house and land package for $750,000 or less. And look, there are some crazy sized blocks in there. There's some 800,000 square meter blocks in there, but the prices are astronomical. So they kind of cover the spectrum. 800
square meters, is that what you mean?
For a new property.
Yeah, not 8,000 square meters. Anyway, that's right. Yeah. No. Yeah. Okay, that's very, very interesting. I wonder what the from 652 means.
That would mean a smaller 3-bedroom house, single car garage on a 300 square meter block.
Yeah. Okay. All right.
And you know, so let's say that's the sales price, and a home buyer is going to buy in there. They'll then get $35,000, combining the state $10,000 grant with the $25,000 from the builder.
Yeah. So would they still need their own deposit, or can, I guess you'd be able to answer that question, can people like buy into this just by using the grants? Okay, don't answer it. We'll answer it next.
Yeah. No, I mean, the thing that comes to mind would be meeting the minimum 5%, genuine savings requirement So usually when you're above 80% LVR, you would need to show the bank that you've been able to accumulate or save. Generally, savings is the default or the standard. 5% of the property of the value of the property saved. There are other ways. Sometimes they include rental amount paid over a period of time. Sometimes if you use guarantors and go below the 80%, that requirement drops.
And what about if they qualify for the government's first home loan deposit scheme? Gee, there's so many.
Yeah, so that'll help reduce all the costs. So let's just say, best case scenario, you didn't, for some reason the numbers stacked, so you don't need to pay anything and you just need to get the loan. There's that one criteria, which is the genuine savings.
Okay,
I think
alrighty.
I did look a while back, like talking more than 6 months, 6 to 12 months ago. There was only one lender who would accept grants as part of the 5% genuine savings. Everyone else was a no. So I don't even know if that's still being, but yeah, generally you still need to save.
Alrighty. So back to you, Scott. So what other tips do you have for us?
I think another thing I wanted to talk about is some of the large numbers that are being thrown out there online. We've got a bit of noise coming in here from the outside. Sorry, I think the gardeners are out doing the.
We can't hear it.
You can't hear that? Okay, well that's good. I'll stay a bit close here.
Do we need to cover off these images before you?
Why don't we just do a quick flip through the images? So what you're looking at are some 2-bedroom terraces in Leppington. We've got some buyers that can't afford a $600,000 house. You know, their budgets are in the mid 500s. They don't want to buy a unit, and effectively what we found are these 2-bedroom terraces that are being built very close to Leppington Station. So you're within 2 kilometers of Leppington Station. It's a 2-story build. So you've got a 2-bedroom terrace. You do not get a garage for that price. You're going to get a car space, but you've got parking nearby. And those are priced around $560,000. So a first home buyer could use his $10,000 grant against that. And he could actually use the first home low deposit scheme that Ken's mentioned to avoid mortgage insurance and get into that property with a 5% deposit. Now, is this the long-term family home for a couple with kids? You know, probably not, but is it a nice place to live for a single or maybe a young couple just getting started? Hey, I would say it's you know, it's a new build. It's got a bit of space, and if you're comparing it to an apartment, I would say you've got more space typically on these terraces.
And any tips about the quality of the builder?
What we're finding is that just like when you go to buy a new car and you see the advertised price, it's always the lowest price available and it's without any of the add-ons. So you're going to see a price from these builders that includes the bare basics of amenities, lower ceilings, laminate bench tops. It's a little unfortunate because I feel their specs are really too low and not too many people will want them. So I think you need to, one is assume you're going to pay another $10,000 to $20,000 to get the actual features in these properties you want.
Like the Porsche.
Yeah. We can try to negotiate with the builders, you know, and try to squeeze a bit of that out of them. So we do some of that for our clients.
Okay.
Beware of the cheapy builders out there. There are some super cheap builders, just ridiculous home build prices I see out there. I'm very worried about the size of those homes, the quality of them, and you've got to think about resale values as well. So if the builder doesn't have a great reputation and you want to upgrade from this property in 5 years, I mean, most people are going to know who's built these homes, and you know, maybe harder to sell them. So stick with medium to high quality at a medium price tends to be my rule of thumb.
Alrighty, so we have to start wrapping up. So is there any final point that you'd like to make?
I get calls from people all the time and they're asking me about properties and areas. Your first step has to be to figure out what your budget is and talk to a mortgage broker. So, you know, you got to get a meeting, get on a phone with somebody like Ken, work through your numbers before you're out looking at things online. You can really waste a lot of time. So start with getting your own numbers together, figure out whether you want to live in the property long-term or whether you're going to move out of it, turn it into an investment property, and then figure out what your situation is with the grants and so forward, and whether you can take advantage of them or not. So hopefully that gives your Mythbusters watchers some tips.
Yes, that was very good, Scott.
All right. Thanks, Scott, and thanks for joining us. So yeah, thanks for watching. If you love, we'd love to receive your feedback. Please join Property Mythbusters group and send us questions on myths or anything that you would like busted. You can contact us directly through our company websites and social media channels.
Okay.
So, all for today.
Bye.